Welcome to this overview of the Reserve Bank of India's RBI Directions for Small Finance Banks, titled Income Recognition, Asset Classification and Provisioning, issued in 2025. These guidelines aim to bring consistency and transparency in the operations of small finance banks, SFBs, particularly in handling advances and loans. This will help in maintaining the overall health of the banking sector and support better financial practices. Chapter 1 of the directions is focused on the preliminary aspects of these guidelines. The Reserve Bank of India, in line with international practices and recommendations, introduces these norms to bring greater transparency and uniformity in income recognition, asset classification, and provisioning. The directions are officially titled the Reserve Bank of India Small Finance Banks Income Recognition, Asset Classification and Provisioning Directions 2025 and are effective immediately. These directions apply specifically to small finance banks and also cover restructured accounts, in addition to the existing guidelines for NPAs. Chapter 2 lays down the general instructions for SFBs regarding their role in ensuring proper financial management. This chapter stresses the importance of the board in framing policies that are aligned with prudent lending and financial education practices. The board must approve a policy on income recognition that is objective, based on the record of recovery rather than subjective factors. It must also include provisions for creating floating provisions and provisions for standard assets. Moreover, the bank's board is responsible for ensuring a robust system for the early identification of problem loans and improving overall asset quality. Additionally, Chapter 2 emphasizes the importance of consumer education. It instructs SFBs to make sure borrowers understand the terms like overdue, special mention accounts, and NPAs. Finally, disclosure requirements mandate that banks disclose all the necessary financial information in their notes to accounts, ensuring complete transparency. In Chapter 3, the focus shifts to asset classification. Here, banks are required to classify loans either as standard or non-performing assets, NPAs, based on objective criteria. SFBS must establish a robust management information system, MIS, to detect early signs of distress at both the individual account and segment levels. The guidelines also call for the automation of the asset classification, upgradation, and provisioning processes. The system should be capable of flagging NPAs and updating the classification status in real time, minimizing manual errors. Furthermore, the directions include specific rules for cases such as consortium loans, where recovery from one member might not automatically be reflected in others' books, necessitating separate NPA classification for each member. Chapter 4 provides detailed guidelines for provisioning norms, which are vital for ensuring financial stability. Provisioning must be based on the assets classification. For example, SFBs need to make provisions for substandard, doubtful, and loss assets, with the level of provisioning depending on how long the asset has been non-performing and the availability of security. This chapter highlights the responsibility of SFBS management to make adequate provisions for any losses from loan assets. In addition, it provides special instructions for cases where banks may need to make provisions beyond the regulatory minimum. This includes provisions for frauds, market disruptions, or other extraordinary circumstances. Furthermore, it sets out the rules for floating provisions and how they should be used, ensuring they are not used to cover standard asset provisioning, but only for specific cases where extraordinary losses are encountered. Chapter 5 focuses on income recognition, which must adhere to accrual principles for standard assets. However, for non-performing assets, income must be recognized on a cash basis. SFBs are required to reverse all income previously credited from NPAs once they are classified as non-performing. The guidelines also cover cases like loans with moratorium periods, where interest is due after the moratorium ends. If these loans turn NPA, the interest accrued during the moratorium period does not need to be reversed, but any subsequent overdue interest must be addressed. Additionally, SFBs are required to stop applying interest to NPAs, but continue to track the accrued interest in a memorandum account, which is excluded from gross advances. Chapter 6 addresses the repeal of earlier guidelines, stating that the new directions issued in 2025 replace previous instructions regarding income recognition, asset classification, and provisioning. Any actions taken under the previous directions will continue to be governed by those provisions, ensuring no disruption. Moreover, this chapter clarifies that these new directions do not override other existing laws or regulations. In case of any difficulties or ambiguities in interpreting the provisions, the Reserve Bank may issue clarifications, which will be considered final. In conclusion, the Reserve Bank of India's RBI 2025 Directions for Small Finance Banks establish a comprehensive framework for managing asset quality, provisioning, and income recognition. By following these guidelines, small finance banks can ensure better risk management, transparency, and long-term sustainability. These directions are a critical step in ensuring that SFBs remain financially stable while maintaining a high level of trust with their customers and stakeholders. Thank you for your attention to this summary of the RBI Directions for Small Finance Banks. Munsis and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence, a pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup, operational support, and handling complaints, risk management, renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university, BATF, and ancillary regulations, and fintech, expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA, comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network, scan the QR codes below to stay connected with us.